Stop looking at the ticker tape in New York. If you are looking at the COMEX price on your phone, you are looking at a hallucination. You see the price of silver trading at $74.59. You see the green candles. You see the $3 spike. And you think you are seeing the whole picture. But you're not. You are looking at a ghost. You are looking at a paper derivative market that is currently being strangled by a liquidity crisis, the likes of which we have not seen in 40 years. If you want to know the real price of silver, if you want to know the price that the industrial giants are paying, you have to look 5,000 miles to the east. You have to look at Shanghai. Right now, as we speak. The physical silver market in China is trading at a premium that converts to roughly $100 an ounce. Do you understand the magnitude of this disconnect? There is a $25 gap between the price in New York and the price in China. In the professional trading world, we don't call this a spread. We call this a broken market. A $25 gap is an arbitrage opportunity so massive that it acts like a black hole. It sucks every available ounce of silver out of the West and sends it to the East. In this emergency market update, we are going to dissect the China $100 phenomenon. We are going to explain why the paper market in the US is lagging so far behind the physical reality in Asia. We are going to look at the massive arbitrage flows that are currently draining the COMEX vaults dry. And we are going to tell you why the price in New York has no choice but to rocket higher to close this gap. The dam is broken, the East has set the price, and the West is about to panic. This is the story of the $25 vacuum. To understand why this is happening, you have to understand the difference between spot and street. In New York, the spot price is $74.59. This is the price of a futures contract. It is a paper promise. It assumes that there is infinite silver available, but in China, the market is physical. Solar manufacturers need silver paste. Electric vehicle companies need silver contacts. Citizens need silver bars for wealth preservation. They do not want paper, they want atoms. And when millions of buyers compete for a limited supply of atoms, the price disconnects from the paper market. It goes vertical. The reports we are seeing indicate that while the official Shanghai Gold Exchange spot price is trading around $78, the premiums charged by dealers, refiners, and middlemen have exploded. To get immediate delivery of industrial-grade silver in Shenzhen today, you're paying close to $100. This proves that the inventory is gone. When the price rises $25 above the global benchmark, it means there is a localized famine. China is starving for silver. And because they are starving, they are willing to pay any price to feed the factory lines. This creates a massive problem for the Western banks. The banks are short silver in New York at $74, but the metal is flowing to China at $100. They cannot cover their shorts because the physical metal is fleeing the country. They are trying to suppress a beach ball that is being pulled upward by a giant magnet. Let's do the math on the arbitrage trade. This is the mechanism that will force the US price to rise. If you are a global bullion dealer, you have a choice. You can sell a bar of silver in New York for $74, or you can put it on a plane, fly it to Shanghai, and sell it for $100. The cost of shipping and insurance is maybe 50 cents. The profit is $25. This is a risk-free trade. It is an infinite money glitch. So, what is happening right now? Every available bar in London, Zurich, and New York is being allocated for export. The vaults are being swept clean. There's a giant sucking sound coming from the east. As this metal leaves the west, the local supply in New York drops to zero. When supply hits zero, the price in New York must rise. It has to rise until it becomes too expensive to ship it to China. It has to rise until the gap closes. This means the US price has a mathematical destiny to hit $100. It is not speculation, it is hydrodynamics. Water finds its level. And right now, the level is 100. We need to talk about the decoupling. For 50 years, the COMEX in New York set the global price. If silver dropped in New York, it dropped in China. That relationship is dead. China is now the price setter. New York is the price taker. China consumes the metal. New York trades the paper. The consumer always sets the final price. If Samsung and BYD are willing to pay $100, then silver is worth $100. It doesn't matter what JP Morgan says on a computer screen. The real price is the price at which a transaction occurs. And transactions are occurring at triple digits. This realization is starting to hit the Western traders. Look at the chart today. Silver is up $3.40. It is up nearly 5%. Why? Because the traders realized that $71 was a gift. They realized that if they don't buy now, the metal will be gone. They are chasing the Chinese price. This is the catch-up trade. We saw this with natural gas in Europe a few years ago. We saw it with palladium. When a regional shortage develops, the global price snaps upward to match the highest bidder. We are in the middle of that snap. Now, let's look at the dealer reaction in the US. If the price in China is $100, why are US dealers selling for less? The answer is, they aren't. Go to a dealer site right now. Look at the premiums on a Silver Eagle. Spot is 74. The Eagle is likely 90 or 95. The physical market in the US is already pricing in the China move. Only the paper market is lagging. This confirms that the disconnect is purely a financial phenomenon. The banks are using algorithms to hold the paper price down. While the physical world is transacting at much higher levels, this tension cannot last. Eventually, the paper market breaks. The shorts capitulate. And the price gaps up to meet reality. We are watching the last days of the $70 range. Let's discuss the industrial panic driving this. Why is China paying $100? Is it a bubble? No, it is inelastic demand. China controls the solar panel industry. They have production targets to meet before the end of the year. If a factory manager runs out of silver paste, he shuts down. The cost of shutting down a gigafactory is millions of dollars a day. So, if the silver price jumps to $100, he pays it. He doesn't care. The cost of the silver is tiny compared to the cost of the failure. This is why industrial demand sets the floor. Investors might sell at $100 to take a profit. Industry buys at $100 to stay alive. The floor is moving up because the desperation is moving up. We also have to consider the currency war. The Chinese yuan is weakening slightly against the dollar, but silver in yuan terms is exploding. This creates a safe haven bid inside China. Chinese citizens are seeing their property market collapse. They are seeing their stock market wobble. They are rushing into gold and silver to protect their savings. This retail mania in China is layering on top of the industrial panic. It is a dual-engine rocket. So, what happens next? The arbitrage gap is $25. New York is trading at a 30% discount to Shanghai. This is the biggest discount in history. It creates a massive opportunity for the U.S. investor. You can buy silver in the U.S. for $74, knowing that the true value in the physical market is already $100. You are buying dollars for 74 cents. But this window is closing fast. The arbitrage bots are working. The ships are loading. The inventory is moving. Once the vaults in New York are empty, the price will reset overnight. We could see a limit up move that takes us straight to $80, then $85. The market is trying to find equilibrium, and equilibrium is much, much higher. In the next section of this deep dive, we are going to look at the bank reaction. How do the short sellers survive a $100 price in China? Do they double down or do they fold? We are going to analyze the open interest data to see if the banks are covering. And we are going to look at the year-end squeeze. With 1 day left in the year, the pressure to close the gap is immense. The setup for tomorrow, New Year's Eve, is explosive. The East has spoken. The price is $100. Now, the West has to listen. Let's see how they respond. We need to talk about the banks, the entities that are short this market, the entities that have spent 40 years telling us that silver is abundant. Right now, they're staring at a screen that shows a $100 price in Shanghai and a $74 price in New York. And they are realizing that they are on the wrong side of the most violent trade in history. Usually banks love arbitrage. If a bank sees a $5 gap between markets, they step in. They buy the cheap one, sell the expensive one, and pocket the difference. It is their bread and butter. But today, the banks are paralyzed. Why? Because to capture the arbitrage, you need physical metal. You cannot ship a short contract to China. You have to ship a bar. And the banks don't have the bars. They leased them out. They sold them. They rehypothecated them. The vaults in London, which used to be the overflowing stockpile of the West, are running on fumes. So the banks cannot close the gap. Instead, the gap is closing them. Every time a trader in Shanghai bids the price up to $100, it acts like a margin call on the New York short seller. The global price is rising, dragging the COMEX liability up with it. The banks are bleeding out. They are losing millions of dollars an hour on the mark-to-market value of their short positions. This forces a change in strategy. For decades, the strategy was cap and contain. Sell paper to keep the price down. Today, the strategy is survive and exit. We are seeing signs of massive short covering. The banks are not adding new shorts to stop the rally. They are buying back their old shorts to get out of the way. Look at the open interest. It is dropping. When price goes up and open interest goes down, it means shorts are leaving the building. They are admitting defeat. They are handing the keys of the market over to the bulls. This removes the ceiling. Without the heavy hand of the banks suppressing the price, silver is free to float to its natural level. And as China has shown us, that natural level is $100. Let's discuss the concept of the widowmaker trade. In finance, a widowmaker is a trade that looks smart but destroys anyone who touches it. Shorting Japanese bonds was a widowmaker. Right now, shorting silver is the ultimate widowmaker. Why would anyone stay short when the physical market is trading at a 30% premium? It is suicide. The only people still short are the ones who cannot get out. The entities that are too big to exit without spiking the price to $200. They are trapped in a burning theater with a door the size of a mouse hole. Their only hope is that demand collapses. But as we discussed, demand is inelastic. Samsung isn't stopping. This creates a powder keg. If one major short holder decides to panic, if they decide to buy back everything at market price to save themselves, we get a flash melt-up. We saw a preview of this on Monday. We could see a day where silver moves $10 or $20 just because one bank decided to survive at the expense of the others. There is no honor among thieves during a liquidity crisis. Now let's look at the calendar. Tomorrow is Wednesday, December 31st, New Year's Eve, the final trading day of 2025. This is the most critical closing bell of the year. Why is tomorrow so important? Bonuses. Portfolio managers are paid based on their performance as of December 31st. If they are long silver, they want the price to close at the absolute highs. They want to mark their books at $75 or $80. This creates a massive incentive for window dressing. Funds will be buying tomorrow. They will be painting the tape. They want to push the price up into the close to maximize their fees and their reputation. Look at us. We own the best asset of the year. This institutional buying pressure acts as a tailwind. It means the dip is unlikely to happen tomorrow. The big money is incentivized to buy, not sell. And remember the tax selling we talked about yesterday? That ends tomorrow. Once the tax year closes, the selling pressure evaporates completely. So you have funds trying to push the price up and sellers disappearing. That is the recipe for a breakout. We could easily see silver challenge the $77 level by the time the ball drops in Times Square. Let's talk about the dealer capitulation. We mentioned the premiums earlier, but there is another phenomenon happening. Dealers are starting to buy back silver at above spot. Usually, if you sell your coins to a dealer, they pay you spot minus $1. Today, many dealers are offering spot plus $2 or spot plus $5. They're desperate for inventory. They're calling their customers and asking, do you want to sell? This is the reverse squeeze. The dealers are becoming buyers because they have depleted their stock and the refiners are closed. When the buyback price is higher than the spot price is irrelevant. It proves that the physical market is tighter than the paper market is admitting. This creates a floor. Why would you sell a contract on the COMEX for $74 when a local dealer will pay you $78 for the real thing? Well, you wouldn't. So the sellers leave the COMEX. They go to the physical market. This drains liquidity from the paper market, making it even more volatile to the upside. We also need to look at the currency pegs. China manages the value of the yuan. By letting silver rise to $100 in China, they are effectively devaluing the yuan against silver. But they are doing it strategically. They are saying, we prefer to hold silver than paper yuan. This is a signal to the Chinese population. Get out of cash. When a government signals inflation, the people listen. We are seeing a rush into hard assets in Asia that dwarfs anything happening in the West. The aunties in China, the retail powerhouse, are buying silver bars. This retail wave is unstoppable. It is 1 billion people moving their savings into metal. The West cannot suppress a market that is being bought by 1 billion people. We are outnumbered. And we are out of metal. Let's look at the technical damage to the bears. The chart is broken for the short sellers. They drew lines at $30, broken. Lines at $50, broken. Lines at $70, broken. Every technical indicator they used to justify selling has failed. The RSI is overbought. Price goes higher. The Bollinger Bands are stretched. Price goes higher. This forces the technical traders to flip. The bear becomes a bull. They stop shorting resistance and start buying support. This adds more fuel to the fire. When the skeptics capitulate and join the party, that is when the vertical move happens. We are seeing the conversion of the bears right now. They are realizing that the trend is your friend, and the trend is parabolic. So, as we head into the final day of the year, the setup is perfect. The East is driving the price. The West is trapped. The industry is hoarding. The banks are covering. And the calendar is forcing funds to chase the rally. In the next section, we are going to look at the January roadmap. If we close the year at $75, what happens on January 2nd? We will calculate the pension fund inflow. We will look at the specific price targets for the first week of 2026. And we will discuss the black swan risks that could ignite the market even further. The $100 price in China is coming to America. It is on a ship. It is on a plane. It is in the algorithm. It is inevitable. Stay tuned. We are mapping out the new year. We need to look beyond tomorrow. While the traders are obsessed with the December 31st close, the real money is looking at January 2nd. That is the first trading day of 2026. And it is the day that the rules of the game change. We have talked about the January effect, but we need to quantify it. Global pension funds manage roughly $50 trillion. Currently, their allocation to commodities is near historic lows, maybe 1%. Their allocation to silver is a rounding error. It is effectively zero. But in 2025, silver was the best performing asset. Bonds lost money. Real estate stagnated. Tech stocks were volatile. Silver went vertical. So the investment committees at these pension funds are holding meetings. They are saying, we need inflation protection. We need hard assets. We need to buy the winner. If they decide to move just 0.1% of their capital into silver, that is $50 billion. $50 billion of new buying power. Now, compare that to the size of the silver market. The entire annual mine production of silver is worth roughly $25 billion at current prices. Do you see the mismatch? The pension funds are trying to buy 2 years' worth of global production. In the first week of January, they are trying to push an elephant through a keyhole. The only way the elephant fits is if the keyhole gets bigger. The price must expand to accommodate the capital. This is why the move to $100 is not just possible. It is necessary. The price has to rise to a level where $50 billion buys a meaningful amount of metal. At $74, $50 billion buys everything. At $200, it buys a reasonable stake. So the liquidity wall entering in January will force a repricing event. This buying is automatic. It is mandated. It doesn't care about the chart. It doesn't care about the RSI. It just buys. And it will be buying into a market where China has already vacuumed up the float. It is the unstoppable force meeting the empty object. Let's look at the deficit revisions. The Silver Institute releases its supply and demand data every year. For the last 4 years, they have reported deficits, but the market ignored them. They said, above ground stocks will cover it. In 2026, that narrative dies. We are expecting the Silver Institute to revise their deficit numbers significantly higher. Why? Because they finally have to account for the military consumption we exposed. They have to account for the AI energy demand from Microsoft and Google, and they have to admit that the recycling supply is not coming back. When the official data catches up to the reality, it removes the last bearish argument. The perma-bears who said supply would flood the market will be silenced. There is no supply. This realization will trigger a wave of upgrades from Wall Street analysts. Goldman Sachs will raise their target. Citi will raise their target. They will chase the price higher to stay relevant. And their upgrades will bring in the retail herd. Now, we need to discuss the black swan risks for 2026. The world is unstable. We have conflict in the Middle East. We have tension in the Taiwan Strait. We have a debt ceiling crisis in Washington. Any one of these events could trigger a flight to safety. In the past, safety was the U.S. Treasury bond. But in a debt crisis, the bond is the risk. So capital flees to the neutral reserve asset, gold and silver. If a war breaks out, oil spikes. When oil spikes, mining costs go up. The floor for silver rises. If a currency fails, gold spikes. When gold spikes, silver follows. Silver is the call option on chaos. And looking at the geopolitical map, the probability of chaos is 100%. China knows this. That is why they are paying $100 an ounce. They are not overpaying. They are paying the war premium. They are securing the metal before the sea lanes close. The West is sleeping. The East is preparing. And the price difference, the arbitrage gap, is the cost of that complacency. Let's talk about the psychology of 3 digits, $100. It is a magical number. When an asset crosses $100, it changes how people perceive it. At $99, it feels like a commodity. At $100, it feels like a store of value. It gains legitimacy. It attracts the wealthy saver who didn't want to mess with cheap coins. Now, silver is a prestige asset. This brings in the family offices, the high net worth individuals. They want to own the asset that just crossed the century mark. They want to hold the bar that is worth $20,000, not $5,000. Density of value matters to the rich. As silver gets more expensive, it becomes more practical for large wealth storage, not less. We also need to look at the unit bias for the small investor. At $100, a 1-ounce coin feels expensive to a kid, so the market will adapt. We will see fractional silver become the standard. Half-ounce coins, quarter-ounce rounds, gram bars. This happened in gold. Nobody buys an ounce of gold casually anymore. They buy grams. When silver switches to a gram pricing model, it unlocks a new demographic. People who have $20 can still participate. This sustains the retail demand even at high prices. The market evolves to keep the squeeze going. Let's pivot back to the physical delivery numbers on the COMEX. We are entering the delivery month. Traders who bought contracts for January delivery are about to ask for their metal. Usually they roll the contract or settle for cash. But with the Shanghai premium at $25, why would you settle for cash at $74? You would be throwing money away. If you take delivery of the metal, you can sell it to China for $100. You make $25 an ounce instantly. So, the incentive to stand for delivery is the highest it has ever been in history. Every rational actor must take the metal. This means the drain on the COMEX vaults in January will be catastrophic. They could lose 10 million, 20 million ounces in a single month. If that happens, the registered inventory hits zero and the game ends. The banks know this. That is why they are panic buying now. They are trying to get the metal before the delivery notices go out. They are trying to front run their own clients. It is a race to the bottom of the vault, and the vault is shallow. So, as we look at the chart today, $74.59. Do not see it as a price, see it as a countdown clock. Every cent it rises is a tick closer to the moment the vault runs dry. Every cent it rises closes the window for the paper shorts to escape. We are counting down to a default, a soft default where paper settles for paper and metal settles for a king's ransom. We need to prepare for the regulation narrative. When silver hits $100, the government will blame you. They will say it is speculation. They will talk about market stability. They might raise margin requirements again. They might launch an investigation into hoarding. This is noise. It is the sound of a government losing control of its currency. Do not let them gaslight you. You are not the problem. The $36 trillion of debt is the problem. Silver is just the smoke detector. The debt is the fire. You don't smash the smoke detector to put out the fire, but they will try. Be ready for it. Ignore it. Keep stacking. Let's summarize the setup for January 2nd. We have the pension funds entering. We have the industrial restocking. We have the COMEX delivery cycle. We have the Shanghai arbitrage. We have the geopolitical hedge. All five forces are pushing in the same direction. There is no counterforce. The only counterforce was the bank short, and the banks are covering. The sellers have left the building. This is why the vacuum exists. There's nobody left to say no to higher prices. We will look at the specific price targets for the first week of the new year. We will discuss the exit strategy. When do you actually sell? And we will give you the final verdict on the China $100 reality. The East has set the price. The West is just realizing it. The transfer is complete. The final countdown to 2026. We have dissected the $25 spread between New York and Shanghai. We have exposed the industrial hoarding and the bank panic. We have mapped out the massive wave of pension fund capital arriving in January. Now, we must look at the most important part of the equation. You, the individual investor. You have survived the bear market. You have survived the manipulation. You are now sitting on a winning lottery ticket. But holding a winning ticket is dangerous if you don't know when to cash it in. In this final breakdown, part 4, I'm going to give you the exit strategy. I'm going to explain why selling for dollars at $100 is a mistake. I am going to teach you the ratio trade, the secret tool the wealthy use to lock in gains without ever going back to fiat currency. And I'm going to leave you with the final verdict on what the first week of 2026 will look like. The East has set the price at $100. The West is catching up. Let's finish this. Let's address the urge to sell. Why do you want to sell? To get profit. But what is profit? It is dollars. It is fiat currency. You are trading the scarcest, most strategic industrial metal on Earth for a piece of paper that the government prints by the trillion. Think about the macro environment. The debt is $36 trillion. Inflation is resurging. The bond market is cracking. The dollar is the burning building. Silver is the fire exit. If you sell your silver at $75, you are running back into the burning building because you found a few extra dollar bills on the floor. It doesn't make sense. The smart money never sells for cash. They swap. They trade one undervalued asset for another undervalued asset. They move from the overheated room to the cool room. They never step outside into the cold air of fiat currency. So, what do you swap for? Gold or real estate? But gold is the easiest to track. Right now, with gold at $4,500 and silver at $75, the ratio is 60 to 1. It takes 60 ounces of silver to buy 1 ounce of gold. Historically, this is still cheap. In 1980, the ratio hit 17. In 2011, it hit 30. Geologically, it is 8. Here is your roadmap for the exit. Zone 1, ratio above 40. You hold, you accumulate. Silver is still the best horse in the race. It has more room to run than gold. Zone 2, ratio hits 30. This is your yellow alert. The market is getting frothy. You might swap 20% of your silver stack for gold coins. You're locking in the volatility. You're trading the wild silver for the stable gold. Zone 3, ratio hits 15. This is the red alert. History tells us that 15 to 1 is unstable. It marks the peak of the mania. At 15 to 1, silver is historically overvalued relative to gold. You walk into the dealer. You hand over your monster box of silver. You walk out with a tube of gold. You have effectively tripled your gold stack for free. You never touched a dollar. You never paid capital gains tax. You just played the ratio. This is how dynastic wealth is preserved. You move capital from the high volatility asset to the low volatility asset at the peak of the cycle. We're not there yet. At 60 to 1, the ratio screams buy silver. But you need to know where the exit is before the theater catches fire. 15 to 1 is the exit. Now, let's look at the immediate future. The first week of January. We enter the new year with maximum momentum. New York is trading at 75. China is at 100. The gap must close. I predict that in the first 5 trading days of 2026, we will see silver break $80 in New York. The January effect buying combined with the arbitrage vacuum will be too strong to stop. We might see a gap up on January 2nd that shocks the world. The banks will try to fight it. They will release bearish reports. They will talk about interest rates. But they are fighting physics. They cannot print silver, and until they can, the price has to rise to ration the remaining supply. So here's the verdict on the China $100 news. It is the most significant signal of the decade. It proves that the paper price is dead. It proves that the physical price is the only thing that matters. The world has bifurcated. The East has the metal and the high price. The West has the paper and the low price. But nature abhors a vacuum. The West is about to get a wake-up call. If you are holding silver, you are holding the winning hand. Do not fold. Do not get shaken out by volatility. Do not sell for pennies when dollars are coming. The transfer of wealth is not coming. It is here. It happened while everyone was watching the stock market. You saw it. You acted. Now, enjoy the ride. 2026 is the year of the squeeze, and you're ready. Subscribe.